Hello, and welcome to the weekly economic brief. My name is Dr. Lindsay Piegza, Chief Economist at Stifel. Last week, investors took a fresh look at inflation, beginning with the Consumer Price Index midweek on Wednesday. The headline CPI rose 0.2 in February and 2.8% year over year, a tenth of a percentage point less than expected, and the first month of cooling after 4 consecutive months of acceleration. In the details of the report, other goods and services prices rose a sizable 0.6% in February, while a number of other components, still increasing, cooled their rate of ascent from the month prior, including recreation prices, shelter, commodities, and education and communication prices, as well as energy prices. With airline fare prices, on the other hand, dropping outright a whopping 4% in February, the largest monthly decline since June. Year over year, airline prices fell 0.7 and are down over 1% for the past 5 years. Excluding food and energy costs, the core CPI also rose less than expected, up 0.2 for the month and 3.1% on an annual basis, also cooling from a 3.3% pace reported in January and marking the smallest annual increase since April of 21. Additionally, looking at another iteration of inflation, the supercore, defined as core services excluding housing, rose just zero point 0.2 in February, following a 0.8% rise the month prior and 3.8% over the past 12 months. While still nearly double the Fed's intended target of 2%, this does mark the smallest annual increase since October of 23. Turning to producer prices now, the PPI was unexpectedly flat in February and rose 3.2% on an annual basis. This is a tenth of a percentage point less than expected and the smallest annual increase in 3 months. While the core PPI fell outright, down 0.1 in February, the first monthly decline since July. Over the past 12 months, the core PPI rose 3.4% on an annual basis, a tenth of a percentage point less than expected, and a 3-month low. Taken all together, a cooling PPI on the heels of a cooler than expected CPI is a vast improvement. Still, while a welcome directional adjustment, after several months of accelerating price pressures, 1 month's reprieve does little to instill confidence of a sustained disinflationary trend, especially as some of the larger monthly gains in the report suggest some further price pressures to come, particularly in next month's PCE report. Speaking of inflation, then, and reflecting rising concerns regarding elevated prices and further upside inflationary risks stemming from fiscal policies, including additional tariffs, the latest survey based Small Business Optimism report fell sharply. The NFIB Small Business Optimism Index fell just over 2 points to a reading of 100.7 in February, surpassing the expected decline and marking now a 4-month low. Meanwhile, consumers continue to express growing concern regarding fiscal policy, inflation, and the outlook for their personal financial conditions. The University of Michigan Consumer Sentiment Index, for example, fell nearly 7 points to a reading of 57.9 in the preliminary March report, surpassing the expected decline and dropping to the lowest print since November of 22. In the details of the report, a gauge of current conditions fell over 2 points to a 6-month low, while a gauge of future expectations plunged nearly 10 points to the lowest reading since July of 2022. As consumers brace for further uncertainty and potentially higher inflation, confidence continues to decline. In fact, a measure of short-term inflation expectations popped 60 basis points in the latest report, rising from 4.3 to 4.9%, a 2-year high, after already rising 100 basis points at the start of the year. In fact, adding to the growing level of unease and uncertainty in the marketplace, last week the Trump administration unveiled the latest round of international tariffs. Aimed this time at metals, the White House announced increased tariffs on global steel and aluminum exports to 25%. In response, some allies, including the European Union, have already announced reciprocal tariffs, as expected. The EU announced retaliatory tariffs on 28 billion worth of a wide range of U.S. goods, including everything from boats to motorbikes and alcohol, set to take effect April 1st, with additional countermeasures introduced mid-April. And despite the reduction in the tariff rate from the initially proposed 50% to the lower level of 25% on Canadian steel and aluminum imports, Canada announced its own countermeasures, vowing to increase tariffs on roughly $21 billion worth of U.S. goods, including steel and aluminum. Furthermore, the Bank of Canada announced a seventh round rate cut shortly after the retaliatory measures were announced last week on Wednesday, taking its policy rate from 3% to 2.75%. According to the Bank of Canada's governor, the central bank is moving policy, quote, carefully amid the ongoing implementation of tariffs. Finally, last week, in the aftermath of a somewhat softer February employment report showing both an uptick in the unemployment rate and a rise in top line hiring to a 2 month high, an updated look at the number of job openings offered further evidence of a still somewhat resilient but uneven labor market. Job openings, according to the JOLT survey, or the Job Openings and Labor Turnover Survey, rose from 7.5 million to 7.7 million in January, a 2 month high, with the quits rate rising to a 6 month high, the layoffs rate dropping to a 7 month low, and the ratio of job openings to unemployed people rising to a 2 month high. This week, the economic calendar is centered on the latest FOMC rate decision, expected Wednesday afternoon, followed by the chairman's comments and updated perspective during the press conference. While widely expected to maintain policy in the current range of 4.25% to 4.5%, the accompanying communication at this week's policy meeting could tip the committee's hand in terms of primary concerns, a policy lean, and/or the expected timeline for any future adjustments in rates. Maintaining a solid assessment of economic conditions and hiring, as well as the still elevated level of inflation, the Fed is likely to show little adjustment in expectations for additional policy cuts, at least in the near term, as the committee continues to assess the incoming data and uncertainty surrounding tariffs and the Trump administration's broader fiscal policy agenda. The diversion of opinions around said forecast, however, are likely to widen among policymakers. Additionally, the committee could opt to lower the caps on monthly portfolio reductions and/or explicitly identify additional factors, including specific fiscal policies being considered in determining the timing and extent of any policy adjustments needed in the coming months. Returning back to the economic calendar today, we'll start by taking a look at the Empire Manufacturing Index, along with the February retail sales report. After a larger than expected 0.9% decline in January, the largest drop since March of 23, retail sales are expected to rise 0.7% in February, potentially marking a 2 month high. Year over year, retail sales are expected to increase a solid 4.1%, potentially marking, however, the weakest pace in 3 months. Tomorrow, we'll take an updated look at the housing market with February housing starts and building permits, along with import and export price indices, and industrial production and capacity utilization for February. Later in the week on Wednesday, weekly mortgage applications will be released, ahead of weekly jobless claims on Thursday, the March Philly Fed Business Outlook Index, the leading index for February, and existing home sales. And wrapping up the week on Friday, while there are no economic releases to speak of, we will hear from New York Fed President John Williams as the first to speak out in the aftermath of the Wednesday rate decision. Given all of the, quote, uncertainties in today's market, Williams has been clear he is still supportive of where policy currently stands. But going forward, fiscal policies, regulatory policies, and other factors, he says, will play deciding roles in the unknown pathway for rates. And with that, I'd like to thank you for starting your week with Stifel.